the Reddit trend that became Robinhood being oddly against its own principled name. And
Yep.
yeah. Anyway, I think Norman is the person I think to like maybe give us a little sense here. I don't know. Like I don't have the mind to like understand how these financial games are played.
Yeah, like explain it to us like we're 5.
Oh,
Yeah,
okay.
let's do that. You've got young
Well,
kids. You've already told them, I'm sure, what happened, and they were like, "Oh, Dad, I understand it now."
Yeah, don't I wish?
Yeah.
Or explain it to me like I've already lost $5,000 on the wrong side of this trade.
Well, I hope you haven't.
Oh, I can do that for you, Eric. GameStop never trades at a reasonable price.
Just kidding. I'm just kidding.
Wow. All right. Well, yeah. So we're alluding to the absolutely mind-boggling phenomenon of the GameStop stock. And so there's a number of things you kind of have to know to sort of understand that both the background of why this is happening, as well as the mechanics of what's going on and why the pricing is. So everybody knows that basically that the price of GameStop stock is just wildly varying, and it's trading perhaps way over what is one would expect for such a company in today's day and age, which, you know, GameStop is historically has been like a mall-based retailer, although they have plenty of, you know, strip mall locations as well. And what do? Well, they sell video games mostly, and they, you know, a lot of more of just like gear and both the hardware on and software for gaming, as well as just you know, fan type memorabilia,
Super Mario keychains.
Yeah, I mean, all that sort of stuff. So you know what that is, and you know, and the result of COVID has been so many retailers have been hit, and they were particularly hit. But what's interesting is that over the course of the last 6 months of 2020, there were a lot of changes that happened in GameStop. They got a big, high-powered new investor who put like 7% into the company, basically bought like a 7% share, and then ended up investing more, and then he owned about 13% or something to that effect, and got himself 2 board seats on GameStop, and in fact, like they had, a lot of people don't know this, they ended up doing over the course of December like 330% increase on year-over-year sales. So this is not a company that was down and out of the market, period. Okay. Mm-hmm. But what began to be and actually, so then that corresponds, by the way, with a number of people who started going long on GameStop stock well over a year ago. And those are people in a little lesser known Reddit forum called Wall Street Bets. And then the unthinkable happened. What happened in December and in early January is that it began to be noticed that that there were some particular hedge funds that were shorting GameStop stock so much that that what's called the float went well over 100%, and that up to upwards of 140 to 150% nearly. Now the float, it's kind of hard to understand. And so we'll have to, first of all, before we get to that, we'll say, what does it mean to short a stock? Okay, so here I'm gonna have to tell you this like you're 5. Now, normally when you buy a stock and you're gonna hold it, you're hoping that it's going to go up, or you're holding it so that if they give you a dividend, you'll get some residual off of that. And so you want that price to increase over time, because that is an increase in value. And it's somewhat reflective. You're owning a piece of the company at that point. You are an owner in GameStop or IBM or whatever. Okay. Now, shorting the stock is kind of the opposite. Okay. Shorting is where you are betting on, in a sense, betting on the price of the stock going down. And the way this has to work then is you have to borrow the share with the commitment that you're going to sell it back at a future date at the strike price of whatever it is at that point in time. So if the price goes down, then you make money. But if the price keeps going up, then you actually lose money. And because you're borrowing the shares in order to do this, essentially, you end up also paying an interest fee on it. And this is where you get this idea of margin calls. So you're borrowing on a margin, and if the price increases too much, you can get your margin called. And this happens in commodities as well. If you've ever been dealing in gold or silver margin trading, you can encounter that as well. So here's what's really kind of crazy about it, though. When a hedge fund goes and borrows the shares, they can then in turn lend them to someone else. And so essentially it's been borrowed twice, and that's how the float is calculated. And essentially, and so it's basically like how many shares are outstanding at the end of the day with respect to, borrowed versus real shares. Okay. That's where it's, so when you get above 100%, something's going funny. Now, Reddit noticed this. Wall Street Bets noticed this. And they basically said, we are going to call you on this. Because when hedge funds do this, they're basically just trying to drive the price down into the ground. They are saying, we're going to make money on this company going bankrupt. And we're going to do all we can to just trash it. And we've seen this happen before. This has happened in the past. This happened in 2008. Okay. When, even, and businesses have gone down because of people who just said, like, nope, we're not going to let this company exist. And so it's interesting that there's, in the United States, at least, what's called naked shorting is illegal, where that's where you're essentially, you're shorting a stock without actually borrowing the shares that you're shorting. It's a really weird phenomenon. Just Google it and you'll figure it out. But it's actually illegal. But the loophole that's kind of around that is this lending the shares that you just borrowed deal. And it's all, I hesitate. It's not naked shorting, but it's close. Okay. And so when you get this humongous number of shorted shares, that puts you into this very interesting situation where if the price starts going up, margins start getting called. And if margins start getting called, then they got to start buying back the shares. If they're buying back the shares, that's going to increase the demand for the shares. The demand for the shares goes up, the price goes up. And guess what? Now the cycle starts again. And now you could essentially see price go up, margins called. And every day, of course, they're paying interest on these shares too. And so this is what, when you get into this scenario, this is what you call the short squeeze. Okay. This is where it gets awesome, because suddenly now do you have a whole lot of Redditors who are holding these shares and saying, we are not going to sell. You are going to pay, like, you do not get to just to burn this company down. Instead, we're going to burn you down because you are the ones carrying the risk. Because here's the trick. While if you own the stock, your maximum risk is what you put into it. In other words, if I buy stock in, Prax Inc. for $100, my max loss is $100. But if I short Prax Inc. stock, what's my loss level potential? It's actually infinite, because there is no limit to what the stock can increase. It can only decrease to zero, right? It can increase wherever. And I'm paying interest. So this is bleeding the hedge funds dry, and it's freaking beautiful. These are evil sons of a guns at times, and I'm just loving the fact that they're just getting burned.
So I have a genuine question, because I've seen a couple of articles from libertarian guys who are saying, oh, this concept of shorting stock and all of that isn't actually a bad thing.
Correct.
And
that is correct.
Okay. So you can speak to that point first, but also I want to talk more about the fact that if this were a free market that was completely unregulated, like one of the problems with the Redditors that, made a profit from doing what they did, from the, what's it called? The short squeeze, is that Robinhood then, cut off their ability to actually trade, make bank on that. And so how would this actually work in a situation that's unregulated, where you don't have these rules that Robinhood, Robinhood would have to go like put the kibosh on that?
Well, okay. So there's three questions that you basically just asked. Okay. Number one is essentially the short selling like legit? Is that going to happen on a free market? And the answer is yes. Short selling is actually a way of providing liquidity into markets. And that's not a problem. There's nothing that can stop people making this type of deal per se. And technically speaking, there is not a a legit reason why you have to totally prevent even the secondary effect of people lending borrowed shares. However, when you over leverage yourself, like the way that they have, that opens you up to losing the game.
Mm-hmm.
Okay. All of these sorts of momentum type trades are susceptible to essentially disruptions in the momentum.
Mm-hmm.
So even if it's not being traded on the basis of fundamentals of, say, the business balance sheet, which is what some people, what even the hedge funders are like, oh, but they're not, the stock price is not reflecting the fundamentals of actual GameStop balance sheet. It's like, that doesn't frickin' matter.
Yeah.
Okay.
Yeah.
This is absolutely a fundamentals based equation. It just happens to be not the fundamentals you like to be talking about right now.
Yeah.
It's the fundamentals of the game you've been trying to play, Mr. Hedge Funder, which is a difference in market momentum and hype.
Mm-hmm.
Okay. So these things are all totally legitimate on the free market. The hedge funders are just mad because they're losing right now.
Yeah.
Yeah, and the hedge funders, I mean, isn't also part of the problem that the hedge funders have made a huge, their own profits by gaming the system and sort of, through various regulations. So they haven't even played fair this whole time.
Yeah, they have the backing of the Fed and certain other ways that things that retail investors just simply never have had access to. So they're kind of playing in a weighted system already. So again, the fact that they're losing at their own game pisses them off. And that's why this is to be celebrated, left and right.
So
for these,
so in a free market, the guys on Reddit, in a free market where the guys on Reddit are able to figure out the short squeeze, that's sort of like a consumer regulation, isn't it?
Oh, definitely. This is calling them on their own irresponsible betting game, essentially, and that's what's great about it.
Yeah.
Now,
Go ahead.
let me kind of address the other two questions. We sort of answered the third one. The second one is, what did Robinhood do? And there's still some question about it. It looked really, really, really suspicious on Wednesday and Thursday as things were happening. But one thing to kind of remember is that Robinhood is technically not the full clearinghouse. Right. So their issue was that part of their issue could have been that they couldn't really provide full liquidity in order to actually they needed more time essentially in order to get the fronted cash in order to help to actually pay off the liquidated position. Right. Okay. So they can't, it's a cash flow problem. And because they're not a bank, they're not technically like a broker. Okay. That's what's kind of odd about them. They're a tech company that is operating with the broker in the background, which is Citadel. Okay. Got it. So that's where it gets really weird. And now I'm not trying to let them off the hook, because the way that they did it was pretty bad. Now here's the other thing though. I kind of need to correct what you said there.
Sure.
People were not in a position where they could always sell. Okay? Yeah. What they were having a problem with is that the Redditors wanted to buy more. Okay. So the worst of it was that when people were under the impression that, oh my gosh, something is going wrong with the plan or whatever. And so then they started liquidating too early, not realizing what they were doing, because oh my gosh, there's no reason to liquidate, guys.
Yeah. Right.
There was no problem with where they were right at that moment. And it was just fluctuation and momentum. And it's like, okay, fine, whatever. As they like to say, diamond hands, don't be paper hands.
Okay.
It's a little joke, apparently, that they use. Yeah. But and so we've now I think we kind of answered all your questions, though. Okay. What you were referring to there is that and it is complicated. There were accusations of total market manipulation on their part, and they're not necessarily wrong. It could have still happened. Sure. But there's also a little bit of a jumping the gun potentially. Which pieces are secondary effects and which are primary effects. It's kind of hard to piece out. But there is going to be a lawsuit against Robinhood, and they definitely lost a lot of goodwill through this. They should have done better. They should have been they try to talk about democratizing finance and being transparent and all that. They really failed on this one. Yeah. So no matter what, they're going to get their butts handed to them after this. I'm leaving Robinhood after this. So as fast as I can. So,
Mm.
whatever.
So as a
Brax, you had a
Libertarian here, I love this story, man. This is
so great. Isn't it?
This is great. I mean, on so many levels. So you've got the disruptor, Robinhood, coming in, and we see this trend all throughout big tech. These disruptors come in, and all of a sudden, they're part of the old guard. They're part of the establishment, like that, And I think they quickly forget how quickly they disrupted and how quickly they can be disrupted. So what they did throughout this situation is they just signaled 100% that they're in the tank for Wall Street, and the meme lords on Reddit have done more for market regulation through this process than the SEC has done in its entire existence. Okay,
Wow.
like it's incredible to see what happened. And I visualize all these these guys that are working at Domino's, kind of like failure to launch guys who live in their parents' basement, who have like a little nest egg saved up, and they're like, you know what? Screw this. I saw 2008. I saw what happened. I saw how they socialized the losses and privatized the profits. And I see a chance here to pounce. And a lot of them pounced on it. And I hope they all become millionaires, trillionaires, billionaires, trillionaires. I couldn't hope for more, because like, I don't know I'm not wealthy enough to make this claim, but like,
we're not offering any financial advice tonight,
yeah.
Yeah.
we're not.
Like my father,
we just like the stock.
my father actually helped open the euro dollar options trading pit in the 80s in the Chicago Mercantile Exchange.
Ooh,
so
that's swanky.
I should know by my blood what options are. I don't. I'm not wealthy enough to know. He's explained to me a million times. I still don't understand it. But
We'll talk.
But now that I'm a libertarian through and through, what a libertarian say is always the answer to just about every human problem.
The market.
More freedom.
Insurance in the market, right?
Insurance. Yes.
Insurance is going to solve all our problems, right? Options are insurance.
Yeah.
Well,
That's
in a manner of speaking, sure.
okay. In a manner of speaking. So if you want to minimize your losses on a position, you can purchase an option.
Yeah,
right.
And it restricts your top level gain, and it restricts your boss.
Right. There's all kinds of like combinations you can buy, an iron condor, like all these things that like. No, I'm serious. Like
credit and debit spreads.
No, that's what it is. Like there's a limit. You can only lose so much, and you can only gain so much. And the game these jokers were playing was kind of like, come on, these guys are in a mall. Everyone's buying their games online now. These guys are destined for extinction. And all the kids that grew up trading in their PS1 and PS2 games for 50 cents and $1 for what they paid $30 for are like, you know what? Screw you guys.
Yep.
We're gonna run this thing to the moon, and you guys can eat crow. And I love that, because it really is using existing market vehicles of managing risk and creating profit that they used to say, you guys were overextended. It's time to pay the piper. And all the whining and crybaby attitude that's come out of that, and how obviously the corporate press has come out and said,
tears of
oh my goodness, just chugging it. It's just like, come on, give me a break. You guys make gravy every day of the week, every year. And the one time you guys get called on it, you're like, oh, help me state, help me government. You're my only hope. And it's like, give me a break.
Yeah.
Yeah. Well, and
Wow.
I really want to hit home the fact that this, this is a form of consumer regulation. We do talk about the fact that the market can solve problems, and it can solve it more effectively, more efficiently than the state can.
Mhm.
And you don't wind up with this thing where the rich are just running everybody else's lives. Like we can actually regulate it ourselves.
Yeah.
What Robinhood did and every other exchange that shut down normal transaction, they were making a calculation, an economic calculation, which was we would rather pay an SEC fine than get taken to the cleaners more than we are right now in the free market.
Wow.
Yeah, I think it's really interesting to see, that just that level of calculation being played out in real time. Because there are things like, there are real things that like the New York Stock Exchange in times of extreme volatility will shut down. They'll tell everybody to cool off for a couple minutes. That is part of the rules, of trading on the stock exchange. Okay. You expect that. And it's also not unheard of to have brokerages, get into liquidity problems, which might lead to not being able to trade on certain stocks. So it was it's hard. I'm not necessarily trying to defend those behaviors per se, because surely there's got to be better ways of doing this, or there's got to be more transparent ways of doing it at least. And the other thing is, by the way, just again, I'll note that that they couldn't lose anything if they didn't sell, and it wasn't that they were the worst aspect that we saw was there were a few positions that ended up getting that, like Robinhood just said, oh, we're closing out your position. I don't know. I do not understand why that is and how that got played into it. I don't understand that at all. That's the most suspicious part. But the fact is, it didn't happen to everybody. So why did it only happen to some? I don't understand the full game behind that. That's what's really, really suspicious here, and things that we definitely need to be watching out for in many respects. But again, otherwise, it's just like, no one was at any risk when you just couldn't buy per se, because as long as you weren't selling, nothing's going to happen.
Right.
Okay. So I think it's a little, it's just a little oddish right now, but it is what it is.